Are you investing in dividend ETFs for monthly income? Be careful, because many investors are making big mistakes that can cost them thousands in long running. In this video, I'm going to show you the top mistakes that dividend investors make and how to avoid them, so your profile will grow and your income will stay safe. Welcome back to the channel, guys. I'm Doug, the retirement guy with the monthly ETFs. I cover everything about monthly ETFs, monthly income strategies, and building a perfect retirement portfolio. If you love the ideas and want to make your money work for you, hit that like button and definitely hit that subscribe. We'd love to have you in the community. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. Information provided in this video is for educational and informational purposes only, should not be considered financial investment advice. For any suggestions, always go to a professional, licensed financial advisor or professional to make any financial decisions. The top mistakes that dividend ETF makers, basically investors, make: number one, chasing high yield. I'm going to be upfront and tell you, this is the number one thing that I ran into when I started doing this in dividends, chasing the high yields. The biggest mistake and the number one is chasing those high yields. A 20% yield might sound amazing, but often it comes with NAV erosion or return of capital. That means while you're getting paid monthly, your account value is slowly shrinking. A better strategy is a balanced yield or a capital preserve program, and we'll show you what we mean by all that. I'm going to show you a fund right here called Yield Max Disney Option Income Strategy. Now, I chose this one for a particular reason because honestly, Disney, very, very solid company, right? And Yield Max is a very solid company with a ton of ETFs out there. So when we take a look at this, their strategy is to take Disney stock through a synthetic covered call and basically sell options on that particular fund. So this was launched in 2023. So it's definitely out there for a couple of years now. So very proud to have this fund. And I looked at this one and said, oh my gosh, we're getting 38.5% distribution rate. I looked at the dividends, very, very strong, right across the board. It's up to 60 cents, down to mid 30 cents. It pays an average 42 cents per month. So when I start looking at this about putting it into my portfolio, I say, wow, if we put $10,000 into this, we're going to generate $3,850 worth of income. That's not bad for that type of application. The problem you run into is when you take a look at this same exact fund, the growth rate is down 22.04%. Look at the stock right now. Look at that thing has gone from a $17 all the way down to a $13.09. And if you've watched this channel before, you'll see that this thing is down. Even April 2nd, when we had the big tariffs, dropped all the way down, and it's never recovered from that point. Now, I'm just using one, just basically a monthly off the shelf. You can do this in a lot of different funds. So if you took your $10,000 and invested into this fund, your loss, your NAV loss is over $2,200. So that means your $10,000 at the end of the year will only be worth $7,796. But remember, it paid a 38.5% distribution rate. So I'm getting $3,800.50 of income. Now, if you're someone like me, you're taking that income and you're paying your bills, you're paying your house payment, you're paying your car payment, you're paying your grocery bill, you're living off of that $3,800. So if that money just gets spent wildly and out the door, your fund is going to continue to drop and drop and drop, and virtually you'll have nothing left after only a few years. So when you take that negative 22% growth rate away, you really only have a 16.46 total return year to date. So that means that $10,000 you invested, technically you're only getting $1,646. Now, is that still a great number? Yeah, it is if you manage it properly. So if you don't spend that 3,850, you only spend the 1646, you're okay because you're going to pour that money back into it to get yourself back to $10,000. So I want to show you one more little comparison. We're going to use Curve Yield Premium Strategy Google. So we're doing Google instead of Disney. That's not really the problem. It doesn't matter who we use, but two totally different funds. The Curve program pays 13.97% distribution, while Disney pays 38.50. So I think when you look at funds right off the bat, you're going to say, I'll take the 38.50 all day long. But when we start taking a look at the next thing, the 10.61% growth of the Google fund and the 22% loss of the Disney fund, you got to start scratching your head because total returns come down to 24.58 versus 16.46. So this is why we say 13.97 is a better than 38.5 because you have to look at the total return that you expect to get from the fund. Now, you always remember, as we said at the beginning, past performance does not guarantee future results. So this is why you have to always evaluate your entire package. Don't always just shoot for that big 38%. When the 13% one's probably a little bit better and a little bit safer across the board. This gets really big when you start seeing some big numbers like 100%, 150% that are out there. I want you guys to be very, very safe and very understanding about what that growth of that fund is all about. Next, number one, ignoring NAV erosion. Okay. The high yield funds can drain your principal over time. Many investors don't even check their NAV trend. If it continues to slide year after year, you're not really earning income. You're just getting your own money back. We just covered that fairly well, but look at this one right here. This one's down 41.06%. That's true NAV erosion. This is a 1 year program that we clicked on, this one fund, and look at how it's just continuously dropping and dropping and dropping. Where are the upsides? Where is any upswings in this? And this is what we're trying to explain. You just showed how the NAV erosion can kill your funds when you're first looking at how much I'm going to make, 38%. But here's a fund, if you're only making 38% and you're paying out 41%, you're losing money. And this is why you have to take the two steps together. What's your total return on a fund? You want to look at this, and you want to look at this on a regular basis. Now, so many people use NAV erosion's wording, and I don't care how you want to do it. I'm not in an argument of how you want to word that out. But the true NAV erosion is not that it dropped today. That's just a change in the dollars and the value of it. What you really are talking about with NAV erosion, if you take over at 1 year and you see it start at one point and drop all the way down, NAV erosion. You see that over a 2 year, 3 year program, you have a fund that you want to be out of ASAP. Again, I will tell you, I bought a fund back when, and it exactly did that. I was so excited. I was getting this huge return. I got my brother invested into it. And he actually was the one who straightened me out back then. And this is many years ago. He goes, do you know we're losing more money than we're actually gaining? And we had to really pay attention to this. So these mistakes are not for just, a smart guy doesn't always get it too. Everyone makes these same mistakes. That's why we want to make sure we help you out of the quicksand. So number 3 mistake, no diversification. Another huge mistake is putting everything into one dividend ETF. Even strong funds like JPEI, JPEQ, or even Omaha have risks. By spreading across different sectors, covered call funds, REITs, international ETFs, you create a safer income stream. So what we're saying is don't put all your eggs in one basket. So when we talk about things, and I think I've showed this in a few other videos that we've done, is think of a pie chart. Think of your chart, and in 5 different sectors, you have your high income sector. You have your REITs, which is the real estate and trust investments. You have BDCs, which is the banking side of things. You have some international put into it. So you have a well-rounded package. Now, people always think ETFs are the safest bet to put them in, and they are very, very good. But you also have to look deeper into each ETF that you play with. I'm going to show you something here with JEPQ. Now, I love JEPQ. This is not anything against them. If you hold it now, I'm not going to reprimand you. Look what they have. 43% of their fund is in technology. 11.67% is consumer discretionary. They have communication services, healthcare, consumer staples, utilities, very roundabout package. We look at their holdings in stocks, and you got Nvidia, Microsoft, Apple, Broadcom, Alphabet, Amazon, Meta, Netflix, Tesla, Costco. So they're well balanced across the board. So I'm very impressed with JEPQ. But let's take a look at their competitor, QQQI, which I know so many people have JEPQ and QQQI in their portfolios. Now, look at the two. They almost identical to each other. Now, QQQI has a little bit more technology by about 8 percentage points. Okay? They have your consumer services make up about 4% of that 8%. So they are so well balanced between each other and doing the exact same thing. If you have both of these in your portfolios, you have apples and apples, when you really want to have apples and oranges. When I take a look even deeper into the holdings of these things, take a look at their stocks. Number 1, both of them, Nvidia. Number 2, Microsoft. Number 3, Apple. Number 4, Broadcom. And then all of a sudden we start to get in a slight little change. One has a little more Alphabet, one has a little more Amazon. They both, Meta, little here, little there in the Meta side of it. So what I'm saying is these two funds are identical to each other. So if you have this in your portfolio, you have a duplication. And this is where the mistake comes into. I'm not saying either one of these twos are bad, and I'm not saying that it's bad to have them both in the same portfolio. What I'm saying is you have 2 apples. Time to buy an orange. Time to buy someone who doesn't have all the technology. Find an ETF that's doing more into the banking side of it. Maybe find something that's doing more in the REIT side of it, which is the real estate investment that are doing warehouses. You're not going to make as much percentage-wise, but you're balanced across the board that if technology drops, these two are going down big time when a REIT was probably going to hold on its own. The number 4 mistake, and that is forgetting about taxes. Dividends are always tax friendly. Some are qualified, some aren't. Some are covered call income, can be taxed at ordinary income. If you're not paying attention, you could lose 20 to 30% of your income to taxes. Always check the ETF which fits best in a taxable account or a retirement account. Because you know what? Mr. IRS, Mr. Uncle Sam is going to come for his money one way or the other. And if you make it, he wants as much as he can possibly get. Now, I am not going to tell you I'm a tax guy. I am not going to be anything here. I'm going with what I found from Homer Simpson. Free tax advice? Please consult your tax advisor. I'm not going to get into details about how to get to deal with the taxes on side of things and how the things are break down, because this could be a 2-hour conversation on taxes alone. on ETFs because they are looking at every possible realm. They're looking at everything to try to get around as much as you can. I did a video on ROC, return of capital, already to try to help explain people of what that's all about. There is so much onto this, it could be a channel all on its own. But let me give you some real quick stuff here. Number one, dividends. The dividend payments are basically from stocks or other income producing assets inside the ETF. If an ETF holds dividend paying companies, the cash flows are passed on to the investors and they can be qualified at a lower tax rate or non-qualified tax as ordinary income. Again, this is why I tell you this is going to get very, very confusing, and I don't want to confuse anybody. But there are qualifying dividends, there are non-qualifying dividends. When they're qualified, that means they're coming over to you as capital gains. And those capital gains can be from 0, 15 to 20, I don't know what it is now, but I believe it's 20%. The non-qualifiers, you could be what tax bracket you are, from 0 all the way up to 37%. So you got to understand which ones are qualified and not qualified. Now, capital gain distributions. Now, this is where you start finding a lot of the funds lately are calling their dividends, and they on one hand, they call them dividends, but they're actually called distributions. Because when an ETF sells securities inside of the fund for a profit, covered calls, synthetics, it may be distributed as capital gains to the shareholders. Most ETFs are very tax efficient, so capital gain distributions are rare compared to mutual funds. Okay, if you receive them, they are usually taxable in the year that they're paid. Again, I know we're getting off in the confusing zone, but basically, ETFs are always trying to find the most tax effective way for you. That's why they were so exciting that so many people wanted to get into it. And the number 3 that gets into it, a lot of ETFs use return of capital, ROC. Now, I told you before, we've done a video onto it. I highly recommend you watch that video so you understand more to it. But common in covered call ETFs or certain REIT ETFs, it lowers your cost basis, which means you pay taxes later when you sell the fund. Now, too much ROC will lead to NAV erosion, so it's important to monitor. I do this and I monitor this on every channel. We will be spreading it on our Patreon group on a regular basis, that we try to show you what the ROC is each and every month, so you can keep an eye on to it. And I see people have already been educated where they're answering questions to me and saying, hey, I'm seeing this ROC is 100% and the assets under management are coming down. That means they're taking money out of my pocket. And the answer is true. So this is a whole another segment to it. Taxes are a whole nother avenue to it. And you just have to educate yourself to find out what funds are using ROC. And that's the best point to do it, because a real quick answer for you is an ROC is they will mark it as they're returning so much of your capital back to you in a distribution. But you're not, and then you don't have to pay the tax onto it until you sell the product. So a lot of going on here. So understand what you want to do. Do some a little bit more education of the tax side of it, the qualified dividends, non-qualified, what's ROC, and we're out there to help you with it. Number 5, unrealistic expectations. Finally, many investors think dividend ETFs are magic money. It basically, the truth is, even the best ones have trade-offs. Lower growth, capped upside, NAV risk. Dividend ETFs are very powerful tools, but they should be a part of a bigger, balanced approach. I really get this when I get asked a lot, can I retire with $250,000 and do it all from dividends? Well, the answer to it is so big and so deep of a question, and that is yes, you can, if you buy the right dividends, but you better be on top of it day in, day out. I highly, highly suggest people that you got to have a balanced approach. You're going to have some bonds in it. You're going to have some dividend stocks. You're going to have some dividend ETFs. You're going to have mutual funds. But as we said before, you got to make sure what you want is you can obtain. Okay? If you want to retire with $250,000 in dividends, what's your cost of living? What are you going to come from it? Can you live on $25,000 a year? Then you only need to find a $10,000 or a 10% dividend program. But realistically, you're probably looking for a 20 to 30% dividend. So what I want to say here, guys, is make sure your expectations that you're getting from this is got to be dialed in. You can't have this thing out of whack. So you can't be shooting for the stars. And, if you fall short, you're going to be short. So I want you to have some realistic thoughts to it. So to recap, the top mistakes: chasing only the highest yields, forgetting about everything else. Is I'm going for that big 38%. I'm going for that 50%. I'm going for that 100%. So many people do that. And personally, I have done that. Ignoring the NAV erosion. I've done this one. I've totally done this one. You forget about NAV erosion. You forget what's going to happen to your funds. Number 3, not being diversified. Number 4, forgetting about taxes. And number 5, having unrealistic expectations. If you can avoid these, you'll probably be way ahead of most dividend investors out there, or you've actually been educated well before. Now, I want to hear from you guys. If you ever bought a high yield ETF and it looked great at first and then you were disappointed, drop your experience and tell me what you got in the comments. I love to hear it. Leave the comments about that. If you like the channel that we're doing, hit that like button, and best of all, join us with a subscription. Join on. Cost you nothing. Join the new channel with these monthly ETFs. We'd love to have you. We'll catch you next time.